This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, what we've learned so far in this chapter is how it is that we determine the assessment for any given tax year. How do we relate the relevant period of profit to that tax year? And whether we're dealing with the very first tax year in which we commenced trading, or all the way through to the very final tax year in which we ceased trading, we know, at least I hope we do, the relevant basis of assessment, whether it's the special rules that apply in opening years, whether it's thereafter the CYB, our current year basis rules, or whether then we get caught with the bases of assessment that apply in closing years. We should always be able to determine for whichever tax year we are dealing with, which period or periods of profit or parts thereof are to be assessed for that relevant tax year of assessment. But the figures of profit that we've been using are the figures of tax-adjusted trading profit. And as we've seen since talking through chapters 4 and 5, that to get that tax-adjusted trading profit requires us to do two things. Back in chapter 4, we adjusted the statement of profit or loss to get the adjusted trading profit, adding back all those non-allowable expenses, taking out anything that wasn't trading income. One of the add-backs, of course, as we've said so many times before, was depreciation, where we added it back as a non-allowable expense, and then we spent the entirety of chapter 5 sorting out what replaces it. The HMRC system of capital allowances, of course, there applies. So we then compute the capital allowances again for the period of account, the accounting period. Whatever period for which we have prepared those accounts, we prepare the capital allowance computation for it. And that figure of capital allowance that we compute, that combination of AIA, WDA and possibly even FYA there, the total of those allowances are deducted from the adjusted trading profit to give us the tax-adjusted trading profit. Once done for the accounting period, we'll then be in a position to see in which tax year, or possibly in opening years, that profit or a part of that profit may indeed be chargeable to tax. Which tax year or years will it fall in? So what problems arise when dealing with the capital allowance computation, to begin with firstly in opening years and thereafter in closing years? Well, actually, and thankfully, there's nothing that we're doing here that we haven't already dealt with and discussed in chapter 5. So this is revision. So we know that our capital allowances computation is going to be prepared, and we'll calculate the allowances for our particular period for which the accounts have been prepared. Now, once we've got that figure, it'll be treated as an expense of the period and deducted from the profits of that period. And this tax-adjusted trading profit figure is then what we've been using to determine the assessment for a relevant tax year. Of course, the particular problem about the opening period is, unlike the periods thereafter, as you continue to trade, it won't necessarily be a year. We don't start on one date and automatically choose a date 12 months later as our chosen accounting period end date. We may start to trade on the 1st of January, but it doesn't mean that we then got to choose the 31st of December as our accounting period end date to use thereafter. We can choose whatever date we like. We could go to the next 30th of June, or from the 1st of January to the 30th of June. That would be only 6 months. We could go to the 30th of September, 9 months. We could go through to the following 31st of March. That would be a 15-month period that we're preparing the accounts for. So what happens when, in that opening period, and it's the only time we'll face this problem when dealing with the opening period, what happens to our capital allowances if it's other than a 12-month period? Now, what I hope you remember from this in terms of chapter 5 there is that we have 3 possible allowances available in any accounting period, they being firstly AIA, followed by WDA, and possibly at the very end of our computation, we may have a first year allowance. Now, the only asset that ranks for first year allowance that we see that we need to be aware of in our syllabus, and that 100% first year allowance is available on a low emission car. A car there with CO2 emissions that do not exceed 50 grams per kilometre. But if it's any other cars that we have, cars always the interesting one there when it comes to capital allowances. The problem with cars is we don't get AIA. If it's low emission, we get FYA. If it isn't low emission, we get writing down allowance. But then that level of writing down allowance yet again depends on the CO2 emissions. Is it a level of emissions between 51 grams and up to 110 grams per kilometre there that would attract the higher level of WDA at 18%? Or is it more than 110 grams per kilometre and therefore attracts only an 8% WDA? The AIA, of course, is the main allowance that is available for most plant and machinery that we incur in whatever accounting period. Now, so far as that first accounting period is concerned, that is the one most likely to have included within it the vast majority of your plant and machinery expenditure. You can't start trading until you've got the plant and machinery, the fixtures and fittings, the computer equipment necessary to run that business. So those expenditure items are going to be allocated to that opening period. So it's going to be a big one in terms of capital allowances. So what happens with AIA? Now, we know that the AIA limit in terms of expenditure incurred that is available for the 100% AIA is 200,000. But of course, and this is now where on a period of other than 12 months, the time apportionment exercise comes in, that we may have to, of course, time apportion that £200,000 limit based on the length of the period. And it is a simple apportionment. If we've got a 6-month period, 6/12 of 200 would be £100,000. If it's a 9-month period, 9/12 of 200,000 would be 150,000. If it's a 15-month period, well, 15/12 of 200,000 will, I think, be £250,000 there. So the level of expenditure on qualifying plant and machinery that will rank for the 100% AIA is dictated by that AIA limit. That is dictated by the length of that accounting period. If it's your normal, as it will be from the second period onwards, 12-month period, it's 200,000. But if it's less than or more than, as it may be, probably will be in the opening period, then you have to time apportion that figure. Now, once you've got your figure, whether it's 200, 100, 150, 250, once you've got the figure, you'll then add up by allocating to that opening period what additions took place of qualifying plant and machinery that attract AIA. As long as that figure is still within the limit, 100, 150, 200, 250, then you'll get your full 100% AIA. It is purely that AIA limit itself that is time apportioned based on the length of the accounting period. The writing down allowance, on the other hand, remember we said 18% and 8%. Those figures are per annum, 18% per annum. And on that basis, if we incur expenditure in the opening period, and that opening period is other than 12 months, then that WDA, whether it's 18% per annum on the main pool items, or whether it's 8% on the special rate pool items there, whichever it is, it has to be time apportioned. We're going to reduce down the level of WDA. If it's a 6-month period, we'll get 6/12 of the annual WDA. 9 months, 9/12, 15 months, 15/12 of whatever would otherwise have been the annual WDA. So we need to time apportion that. And again, back in Chapter 5, our very first example that we had dealt with exactly that. Again, I hope you've gone back and revised there the information on capital allowances from Chapter 5. But that first illustration that we had dealt with, I think it was an opening 6-month period. So we time apportioned the AIA limit. We then time apportioned the available writing down allowance. Back then, the only one we knew about was the 18%, but it could be 18%. It could, of course, be 8%. So, other than that, it's a normal capital allowance computation. A normal capital allowance computation, of course, that would require you 2, now this is the opening accounting period from when you started to trade, so there's no tax written down values brought forward. To list out the additions that took place, and if necessary, it's not very likely, but disposals that occurred within that period. And those additions that we have need to be split between the first category to be dealt with, the additions that rank for AIA, remembering that in determining how much AIA, we will have time apportioned the £200,000 AIA limit. But you still allocate the expenditure in terms of, firstly, is there special rate pool expenditure incurred? That will be the first to benefit from any AIA, followed by then other main pool expenditure. Pick up the AIA, put it into the allowances column. If, of course, the total expenditure for the opening period was more than the AIA limit, whatever figure that might have been based on the annual 200,000, then that residue of expenditure drops into the relevant pool, be it main pool, be it, of course, your special rate pool. So then when we do our WDA, it's time apportionment time. We will not get the full 18% or the full 8%, we'll get the time apportioned amount of that, whether it's 6/12ths, 9/12ths or 15/12ths, whichever it may be. Of course, the expenditure that ranks for WDA in this opening period isn't just the excess over your AIA limit on qualifying plant and machinery. We know that if you buy cars, there's no AIA, and you'll only get FYA if it's low emission, if it doesn't exceed that 50 grams per kilometre limit there. But if it's any other level of grams per kilometre CO2 emissions there, then we're either going to get 18%, usually again as a part of your main pool WDA calculation, or 8% as part of your special rate pool calculation. So again, these figures of WDA will need to be time apportioned. Now, of course, there I reference those cars based on CO2 emissions being allocated to either the main pool or the special rate pool. It is, of course, perfectly possible with the car that it doesn't actually get related to either of those two pools. Why? It's a non-pool purchase. Why is that? Because the car purchased has private use by, now only one person, the proprietor there. Remember, not an employee of the business. We're only dealing with private use by the proprietor. So that means we have to segregate it out. Segregate it, yes, it's not in main pool, it's not in special rate pool, it's in its own individual column. But you still need to claim the relevant WDA, and that's the time apportioned amount of that based on the length of that opening period. Remember, it does not matter when within the accounting period the asset was purchased, whether it was the first day of the 6-month or 9-month or 15-month period, or whether it was the last day of that period. It doesn't matter. What dictates the level of allowance available is the length of the period itself, not the date upon which you happen to buy that asset within that opening period. It is the length of the period that dictates the level of writing down allowance and the AIA limit that is available to you, not the actual date upon which you happen to buy it. That doesn't matter. As long as the date is within that accounting period, the length of the period will dictate the level of AIA limit and, as we're talking about now, the amount of available WDA. So whether it's again going into a pool, whether it is non-pool, you still need to compute the time apportioned WDA there. Another issue. We said, of course, that probably most of your plant and machinery expenditure for, again, some years is likely to take place in that opening period. You can't trade without having the plant and machinery, the fixtures and fittings there to be able to pursue that trade with. Now, you don't necessarily need all of those things, to start trading. Some may come along later. You don't need a car to go through the business, for example, from day one. But what you often see in terms of opening years examples is, as may very well be the case, you're actually going to incur what we call pre-trading expenditure. Pre-trading expenditure. Because you have to buy the plant and machinery, you have to buy the fixtures and fittings before you can actually start to trade. Not a problem. If you buy assets in, for example, November, December, but you start trading then on the following 1st of January, a month or 2 months later, all that happens with the expenditure incurred prior to the commencement of trading, pre-trading capital expenditure here, is that expenditure, so long as it's on qualifying plant and machinery, is simply treated as being bought on the first day of trading, and your normal allowances will therefore ensue and be available. It doesn't change it. You don't lose out just because obviously you've had to buy the plant and machinery, the fixtures and fittings before you started to trade. So pre-trade capital expenditure will be treated as if incurred on the first day of trading, and your normal AIA or WDA or FYA will be available accordingly. Okay, let's just look therefore at the note that we've got here to repeat what we have just said. Capital allowances, as we know, are deducted from profits before the opening year rules are then applied. Up until now, in this chapter, it is the tax-adjusted trading profit after deduction of capital allowances that we've been using in working the assessments for the relevant tax years. For an accounting period longer or shorter than 12 months, it is the AIA and the WDAs that need to be either scaled up or down as appropriate based on the length of that period by comparison to 12 months. Any FYA, 100% on cars with low emissions, of course, well, that's never time apportioned. Whether your accounting period is 3 months, 6 months, 9 months, 12 months or 15 months, it doesn't matter. It's a one-off allowance because you incurred that expenditure in that period. It is never time apportioned there. Okay, we've got now an example to deal with, but rather than just focusing, as illustration 1 in chapter 5 did, on just the capital allowances, we've got ourselves a bigger and better example, whereby we're dealing with our hero here, or heroine, Wendy's income tax liability for 2018-19. So we're going to have to take the figure of capital allowances that we compute, and that's going to be the focus of this information here in terms of, that's disappeared, Wendy purchased the following assets as we have there. That doesn't want to stay. Let's just do that therefore and see if that stays. Now, the wonders of technology. Okay, so what you will therefore do, and what I want you to do now, and you can pause this in a moment while you do this, read obviously through the information in the question, as we always must do, in the light of what they want is not just a capital allowance computation, but the preparation of an income tax computation for our 2018-19 tax year. And we're going to compute, as we did back in chapter 2, the income tax liability for that particular tax year. The specific exercise, of course, is focused around these additions of plant and machinery in the opening period. And you, of course, as you read through, will then be able to determine, is that item a qualifying expenditure on plant and machinery, qualifying plant and machinery? And if it is, what type of allowance is available? Is it AIA? Is it WDA? Is it FYA? In terms of the other information, what other information is relevant for inclusion within the income tax computation of the tax year? If you need therefore to go back and remind yourself of that income tax computation from chapter 2, how we put it together, the use therefore of the rates and allowances, the calculation of our taxable income figure, then go back and revise that before heading into this exercise. But if you pause now, do that preparatory work in relation to this example, and then rejoin me and I'll take you through the example and we'll prepare that capital allowance computation accordingly and then move on to deal with the income tax computation. Okay, let's see what you've made of this then so far. Now remember, the requirement It is to compute the income tax liability for our 18-19 tax year. It isn't just calculate the capital allowances, though as we'll see, that's the major part of the exercise we'll need to do. So let's read through what they tell us. Until the 30th of June 18, obviously that is a date within our 18-19 tax year, Wendy was employed here at an annual salary of £40,000. Of course, what then happened on the 1st of July 18, Wendy commenced in self-employment, running a music recording studio there. So she's changed from being employed to self-employed. So in which case, employment income. Now, we haven't seen much of this. I've just given you in examples back in chapter 2, a salary, an annual salary. That was the amount received. So we would be looking here at the amount received. Now, until the 30th of June 2018, that's going to be 3 months worth received. So times 3/12, that will be £10,000 of employment income received in that tax year 18-19. So that will go to the income tax computation. But what we then need to do, of course, is to look at this self-employment. Has become a self-employed and unincorporated trader, starting business on the 1st of July 18 and preparing accounts for the period through to, well, that's going to make life easier, the 5th of April 19, i.e. the end of that first 18-19 tax year. Now, what you'd have done in terms of this exercise in an exam question is, when you looked at and were told the start date for that business, that, remember, fixed what would be the first tax year. So July 18 falls in the 18-19 tax year. What is the basis of assessment? It is always actual. What does that mean? It means the profit, tax-adjusted trading profit, from the start date, 1st of July 18, through to the following 5th of April. Now here, I've been particularly kind to you, because in fact, the following 5th of April is the date that we prepare our accounts to. So we need to establish the tax-adjusted trading profit for that period, and the whole figure, the full figure, is what we will then assess within the 18-19 tax year, using there that actual basis of assessment. So what are we told? We're told that the adjusted profit for that period is £89,000. But of course that is before taking account of capital allowances, and then we've got the list of purchases of those assets where we'll determine the amount of capital allowances. So what do we need to be able to do to put together our income tax computation and calculate that income tax liability for our 18-19 tax year? We know already the employment income assessment, £10,000. The only other source of income will be the tax-adjusted trading profit of this accounting period. Because it's synonymous with the end of the tax year, we want the figure for this period. What is that? It's £89,000 less whatever capital allowances we'll be able to claim in relation to that list of expenditure. All of those dates falling in the period there from the date we started trading through to the following 5th of April. Again, in reality, some of that equipment there, like the 1st of July 18 recording equipment, that may very well have been purchased prior to the time we actually started to trade. Wouldn't make any difference. It would still be treated as if it had been incurred on the first day of trading, and your normal capital allowances will be available. So we've got employment income of 10,000, 89 less whatever this capital allowances computation comes to here will be the tax-adjusted trading profit figure. That will also be shown on the income tax computation. We'll have employment income, we'll have trading income, both of course non-savings income. That will become the total income and indeed the net income from which we'll deduct our available personal allowance there. Again, won't be a problem here about limiting that personal allowance, because whatever the capital allowance is, they will come away from the 89,000. We know we've also got the 10,000. but we're not looking at adjusted net income that has exceeded 100,000, and therefore the problem of reducing the available personal allowance, it's not going to be an issue here. The full 11,850 will be available to you. So that would bring you to taxable income. Then you could apply your tax rates. Again, we'll see, but it's going to be the case here that you may already know that our taxpayer, Wendy, is going to be a higher rate taxpayer. So we'll move through the basic rate band into higher rate band. Employment income, trading income, both non-savings, will be using our basic rate of 20%, our higher rate of 40%. So that said, therefore, we need to determine our capital allowances computation. To do that, we said, analyse the expenditure incurred. So what have we got here in terms of the qualifying capital expenditure? We have got recording equipment. That is just normal plant and machinery purchased for use within the trade. So that £30,000 there will be eligible for AIA. In terms of AIA, what is the length of the period? It is, we here work to the nearest month. We don't worry about the 5 days of April there. That is an opening period of 9 months. Therefore, when we talk about AIA, we'll be limiting to 9/12 of the £200,000 limit, which is 150,000. Well, if you look at the other expenditure incurred, motor car, so there's no AIA there. Computer, that is normal plant and machinery, it is AIA. So that will be AIA expenditure as well. 30,000 and 2,600. We're getting nowhere near that AIA expenditure limit, revised down to 150,000 for this opening 9-month period. So all of it will be eligible for AIA. Now, it also have recognised, of course, that it is normal plant and machinery, so it would have been main pool expenditure. Main pool expenditure. We can just want to write in there. Main, let me write that in there. Get rid of that. Okay, doesn't matter because it's 100% allowance, so there'll be nothing, no residue to go into the pool. The other issue would be about writing down allowance. Will writing down allowance be available? Well, not in relation to this expenditure, it won't, because we get 100% allowance because it's well within the 150. Had we been talking here about £200,000 of expenditure, only 150,000 AIA would be available. The rest, the balance of 50,000, would have dropped into the relevant either main pool or special rate pool, probably main pool there, and then we'd have claimed the relevant WDA. But again, that writing down allowance will be 9/12 of either your 18% or your 8%, depending on the expenditure incurred. I'm not wasting your time by talking about writing down allowance because, of course, look at the expenditure we've got here. We've got cars that were purchased. Cars with CO2 emissions here that are greater than 50 grams per kilometre. So it isn't FYA, we are talking WDA being available. Now the question is, what level of WDA? And that's based on the CO2 emissions. So 170 grams per kilometre, in excess of 110, that's the lower rate of 8% WDA. 105 does not exceed 110, therefore that's the higher 18%. But we then also got to look at whether or not these cars will be allocated to, in the case of the high emission car and 8%, does that therefore place it in the special rate pool? And with the lower emissions here of 105 grams, does that place it in the main pool? The first one, 170 grams per kilometre. Here's your problem. Used by Wendy, 60% business use. Wendy is the proprietor. Proprietor's private use means that's a non-pool asset. So that is non-pool, must be separated out, and of course the time apportionment will occur in relation to the writing down allowance. It's 9 months worth of what would have been 80% per annum, But your problems aren't over there. Of that 9 months worth of 8%, you'll only be able to claim the 60% business use. So that's an intriguing one indeed there. The second car purchased, not a problem about this private use because it's by an employee, so we don't care what that is. That is not a non-pool asset. That, of course, is a pool asset. Which pool, as we've already determined with 18%, that's going to be main pool expenditure that we are talking in terms of. Okay, so to repeat in terms of those capital allowances, do we have expenditure available for AIA? Yes, we do. We list that. We claim what will be a full AIA of 30,000 plus 26, 32,600. Nothing to go into either pool. We then have other additions that rank for WDA. Both of them are cars. One, the one with private use by the proprietor, Wendy, must have its own special car. Again, indicating the extent of business use, 60% business use there. The other car, given its CO2 emissions, will be allocated to the main pool. On each car, we then must compute the available WDA. It's going to be 9/12 of the relevant figure of 8% or 18%, and then having got that figure and deducted it from the costs incurred, for the one with private use by Wendy, we will then restrict that allowance to the claimable figure, which will be just the 60% business use component. Now, all of this is stuff we've dealt with before, so I'd like you, therefore, to work out, to prepare that capital allowance computation, get your capital allowances. What do we do with it? We deduct it from 89,000, the adjusted trading profit. That gives you the tax-adjusted trading profit figure. That figure is then used to determine the assessment for what we want, the 18-19 tax year. It is the first tax year. We work on an actual basis. Thankfully, given the accounting period used, the 1st of July start date through to exactly the end of the tax year, the 5th of April 19, whatever that tax-adjusted profit figure is for that period is also the figure to put in as your assessment for this tax year. We can then prepare the income tax computation. We have employment income, 10,000, and you'll now have your tax-adjusted trading profit assessment for this 18-19 tax year. Both non-savings, get your total income, get your net income, deduct your personal allowance, get your taxable income. As I've already said, it will be in excess of the basic rate band limit of 34,500. So on non-savings income, that limit, basic rate band limit, will be at 20%, and the excess in higher rate will be assessed at 40%. Calculate those tax figures, and you'll therefore have your computation of income tax liability. So do that, please, then rejoin us, and we'll quickly just look through the answer together and make sure that we're happy with each component thereof. But have a little pause now. Okay, well, hopefully by now you've worked through for yourself and indeed reviewed through this answer. Now, the end requirement was to compute the income tax liability here. To do that, we needed to know taxable income. To know taxable income, we needed to know the total income. What was it made up of? A figure that we already knew. Well, a simple calculation, 3 months' worth of employment income received there on an annual salary of 40, gave us £10,000. Our problem was calculating the trading profit. Now, working one shows us the given figure in the question, the adjusted profit. So the missing piece of the jigsaw here was the capital allowance figure that needed to be computed. And for that, we needed to put together the full capital allowances computation. Now, once we got it, assuming my calculations are correct, that figure then goes up to the computation, the income tax computation. We add it to our employment income. We get total income, which is the same here as net income. Take away the personal allowance and get taxable income. You can see here it's all non-savings, so I haven't bothered here with calculate or showing a total income column as well. As it's non-savings, there's no extension of the basic rate band applicable here in relation to any personal pension contributions or gift aid payments. So it's your standard basic rate band limit of $34,500 that's charged at 20%, and then the balance of this taxable income to be taxed, of course, then at 40%. So hopefully giving us the correct figure of income tax liability. So that all hinges on, can we do our capital allowance computation? And hopefully this again has been successfully completed. So what columns did we need? Did we have expenditure that ranked for AIA? Yes, we did. Now again, you don't need to put that title in it, but that's your AIA stroke FYA column. There was no low emission cars bought, so it's AIA. And we know, as we always do, we list out firstly for this accounting period the additions qualifying for AIA. As we knew, we had to net down to time apportion that AIA limit of 200,000. That was 150. Well, the recording equipment and the computer, which is normal qualifying plant and machinery, get nowhere near that. So all of that expenditure is available in our allowances column as AIA. As we said, we'd bought 2 cars, one of which had no private use by the proprietor and CO2 emissions that fell between 51 grams and 110 grams per kilometre. So that expenditure was allocated to our main pool. But the other car, the one with high CO2 emissions, that's the one, of course, that had some private use by the proprietor. Now it's only 60% business use, so we head up our non-pool asset accordingly. So on these 2 figures, writing down allowance will be available. On your main pool, we know it's 18% writing down allowance. But the level that is available, it's, remember, 18% per annum. It's only a 9-month long accounting period, so we limit accordingly. Hopefully, again, do check the numbers out, please. £1,404, which transfers, of course, into your allowances available column. More interesting, more challenging problems so far as the private use asset, the non-pool asset, is concerned. Again, to begin with, just as you've done with the other writing down allowance. Based on the CO2 emissions, it's an 8% WDA. But it's only a 9-month period within which we purchased this particular car. So 9/12 will be the level of WDA we're entitled to. Work that through based on 14,800. Hopefully that's all the 8s there, 888. That figure is deducted in then deriving the tax written down value to carry forward. But of that 888, we only get to claim the business use proportion, which is 60%, and that is the figure that then goes into the allowances column to give us, hopefully, numbers permitting there, the correct capital allowances for the period. And in that way, having got the capital allowances, it feeds back. Put it here as a deduction from adjusted profit. That gives you the trading income. That feeds back to the income tax computation to go in there. And that then allows you to get your taxable income figure. And then you can calculate your income tax liability accordingly. Now, in terms of this exercise, we have been given an adjusted profit for our accounting period from start date 1st of July through to 5th of April of 2019. Now, that, of course, could have been a statement of profit or loss provided to you, and you had to do the adjustment of profit to get that figure. We then had to prepare the capital allowance computation for that self-same period. We've done that. Typical opening period situation where we've time apportioned the AIA limit and the available WDA. Had there been a low emission car purchased during that period, a low emission car there, first year allowance 100%, and that would have been the full figure of 100%. No time apportion for FYA. Now, in this example, the period that we were dealing with was the accounting period to the 5th of April 19. It meant that the figure of trading income that we got was then also the figure, was also the figure to allocate to the income tax computation, because that is the actual tax adjusted trading profit from the start date to the following 5th of April. Now, it could have been more interesting if, for example, the accounting period there, instead of being the 5th of April 19, was the 30th of April 2019. What difference would that have made? Well, obviously the maximum AIA limit would have gone up. It would have been 10/12ths of 200 rather than 9/12ths. Didn't matter because the level of expenditure was well below that. It would have impacted on these writing down allowances. Those would be now times 10/12ths the length of the accounting period. It's a 10-month period if we'd gone through to 30th of April rather than a 9-month period where it's to basically the start of that month. So it would have had 10/12ths. It would have changed the capital allowances. But what it would also do is then change the assessment for our tax year, because that figure would now be the adjusted profit for the 10 months to the 30th of April 19. Therefore, in our first tax year, 2018-19, basis of assessment actual, i.e. start date 1st of July 18 through to the end of the tax year 5th of April 19, this would now not be to the 5th of April but to the 30th of April 19. Therefore, that 10-month period, how much of that would we want? That basis period, we would want 9 of those 10 months of, well, it won't be that number there, but it would be times whatever that figure was. That would be the assessment. That would be the assessment, if you remember what we were doing in the first few lectures of this particular chapter. And it's that figure that would then be included up here as your trading income figure. Okay. Go back, think through that typical exercise that you might have to do in an exam problem. That sorts out our opening period and our first tax year of assessment as it happens there, and the inclusion of it within the income tax computation. What we'll be looking at in what will then be our final lecture on this chapter, you'll be again relieved to hear, is what happens in terms of cessation of trade. Again, no difference there to what we've actually already dealt with back in chapter 5, so you might want to revise back through that, or indeed still possibly just read through that before I take you through it next time. After that, there'll be just one further area to deal with, something called the cash basis for small businesses. Well, I won't spoil that for you now. You can wait until next time, indeed, and we'll deal with it at that point in time.